Welcome to the Risk Reversal Podcast. I am Dan Nathan. That is Guy Adami. This is the Monday edition, Guy.
I love Monday editions. Monday, start the week, fresh start, get it going, fire it up, the whole thing.
Yeah,
me and my mates went out over the weekend.
I know you did. You had a few brewskis. It is a stormy Monday. We're recording this, I want to say midday on Friday. So we've had an interesting day, despite the fact the major indices are unchanged. We're going to talk about what's going on in the AI stocks. We're going to talk about the CME Fed Watch tool, which has been a bit of a yo-yo, Guy, over the last few days or so. Expectations for a rate cut, they're back on for December. We've got a bunch of earnings next week. We'll kind of weave that into the consumer conversation and obviously the AI. But where do you want to start here? Because, you know, there's two, I think, market moving things, despite the fact the market, you know, if you just kind of woke up and you came in here and you looked at the S&P unchanged, you say, not a lot is going on here.
Yeah, well, you know, people will say that I am a hater. You know, I'm pointing the finger at myself, as they say, but I think there are two places to go. The first place I think we should start with is what we've seen in Nvidia. Now, obviously, November 19th was the day that a lot of people were waiting for. That's obviously the day they reported earnings. If memory serves, which it typically does, you saw the knee-jerk reaction higher in the stock in the aftermath of their earnings release. I think we got up to about 197 or so. And as we're sitting here on a Friday afternoon, we're looking at a stock that is now 175. So obviously a pretty dramatic reversal of fortune. Now, it's not an indictment on Nvidia, the company. I want to be crystal clear. I think the point we've been trying to make, and it's been right a few different times over the last couple of years, is although the magnitudes of the numbers are extraordinary, the magnitudes in terms of percentages of beats have been getting smaller and smaller. And I think that, by the way, is natural. That's what should be happening. But I think the stock market wants to continue to reward on absolute numbers. And in my opinion, they should be rewarding, or in this case, penalizing on the slowdown, which was inevitable.
Yeah, and you know, you say it's not an indictment on the company, and I agree. I mean, the performance is great. It might end up being an indictment on the CEO, and I don't mean like indictment, but like as far as the criticism about the hyperbolic sort of commentary that he's had relentlessly. You know, even going back last year when there was all this optimism about Blackwell, right? This next generation from Hopper. Remember there was a bug and it was delayed, and you know he kept on. You know there was no hesitancy about anything, and I just want to highlight the fact between Sundar Pichai at Google and Satya Nadella at Microsoft. These guys are spending like crazy. They are buying Nvidia GPUs like crazy. Obviously, Google has their own TPUs, and they're both trying to kind of second source things. This is one of the reasons why AMD joined the party, right? But both of them have been a bit more sober about where that spend leads them to. Both of them have suggested that we might overdo this, you know what I mean? But right now, they have the cash flow to do it. I mean, there's a whole host of things. Now, Nvidia clearly does. I mean, they have all this demand. Jim Chanos was talking about this the other day after the Nvidia report when Jensen said, we are sold out with Blackwell, and they're looking through the financials, and it looks like there's inventory there. You know what I mean? So again, this is the only reason why I bring up Jensen. But Guy, I almost feel like fine. Nvidia is down 17%. It's still up, 30% of the year. It's up 1,000% or whatever, right? Like that's Nvidia. And that's the way you and I were talking about it on the set of Fast Money when the results were coming out Wednesday afternoon. What you and I were more focused on, though, is the reaction of their customers, right? The reaction of the companies in the ecosystem, right? And so if you just look around, I mean, the hyperscalers gave it up almost immediately, right? Taiwan Semi has started to roll over. We've seen a whole host, SanDisk. On Thursday, this is a storage provider, down 20%. Now, granted, it's been up 500% from the lows, but Oracle, to me, is the main event. As we're recording this right now, it is down 7.5%. It is down 43% from those September highs that our main man, Terry Duffy, CEO and chairman of CME Group, he and I were at the Robinhood Summit that day. We did a hit on CNBC as that OpenAI contract had come out, okay, and then we did a podcast right after. And Terry, who's not a stock market guy, he's obviously a macro guy, a futures guy. He was like, "What the hell is going on here?" And the thing that we were kind of stumped about, Guy, is that the market investors were immediately giving the company the market cap in one fell swoop of the size of the contract revenue terms, $300 billion, that's going to be recognized over 5 to 10 years. That made absolutely no sense. sense. So, Guy, when you see Oracle careening lower because they had a debt-to-equity ratio of 500%, to build this infrastructure out to get that revenue, something is going on here. And if you just want to take it a step further, you got to look at all their suppliers, because if they are not going to be able to build this infrastructure because they don't have the money, then all the suppliers that had gained in the stock market because of the thought they were going to get these orders on the back of it, you got to be careful here.
Well, it's amazing that we're almost about to talk in terms of percentage terms, a stock in Oracle, which at its zenith was, I think, north of $1 trillion, there's almost been cut in half. And that stands since, I think, September 10th was the day. Maybe it was a little bit later than that.
Yep.
But here we are. That is extraordinary move that I don't think people are paying enough attention to. Obviously, we are. To me, it's a cautionary tale. And I think you're going to see more of it. Then you throw on top of that the move in Facebook, which from peak to trough is down, I think, 35%. And that's entirely not on the quarter, but I think now them being penalized by the market for their spend. And the question I've asked a couple different people, and I think most people have had the same answer, that the CEOs of these companies are not going to be focused on their stock price. They have a long-term vision, and they think AI is essential to that long-term vision, which probably is true. But the point that I will make, and I think it's worth at least bringing up, is at what point does the decline in the stock price give them pause and say, hey, the market's not rewarding us for this spend. Maybe we should take another look. And that's going on not only in Facebook and Oracle, but some other places as well.
Yeah, the problem with Facebook, to your point, Guy, like they went through this 4 years ago with the metaverse. They changed the name. And at the time, no one knew what they were really spending, but it was maybe tens of billions, not hundreds of billions, that they were building out this reality labs for metaverse. I mean, this guy went as far as changing the name. I know that you don't use the term
No, I do not.
Meta, but you still call it the Facebook. But, the stock sold off 70%. I mean, listen, if our listeners had $1 for every time that I have said that, or you have said that over the last 3 years, the fact that this couldn't happen again, it's down 27% right now off of $1 trillion number. Back then, it was like a few hundred billion, It could happen now more so because there's so many folks just piled into it, and the numbers are so much larger about what they're spending and the uncertainty of it. They've already taught us this could happen. So that's one of the reasons why, and there's no victory laps or anything. You and I, we talk about these things because we know people get really geeked up. We know that the financial media has been geeked up. We've been highlighting the fact that it's not just the Wall Street Journal or CNBC.com or Bloomberg or whatever else you get your stock market, stuff about. It's been on the cover of the New York Times. You know what I mean? It's on the tips of everyone's tongue. Don't you get asked about it at all cocktail parties or the tailgating that you do or all that other stuff? You know what I mean? Like you're just constantly there's nothing there. Deadpan.
No, well,
Zero.
I got it. I mean, by the way, and yes, I will address that, but it will come as no surprise to you. It may come as a surprise to some of our viewers or listeners that I've never been to a tailgate. As a matter of fact,
surprise.
I'd rather get a hammer and nails and insert them into various parts of my body than to do so. Back to you.
You mean under your fingernails? Well, listen, the point I'm going to make is that the most beloved stocks in 2021, and they were Nvidia, and they were Netflix, and they were Meta, right? And these stocks were able to sell off, 65,
meaningfully,
70%, that sort of thing. So it can happen again. And
it's happening. I mean, to your point, it's happening right before our eyes.
Yeah.
People don't want to acknowledge it, but here we are.
Yeah. And the only point, again, just to finish the point, because I got, sidetracked on your tailgating history, but, I mean, we get asked it. As soon as you start getting asked it, I remember what it was like to be asked about Qualcomm and Nortel and Yahoo and AOL, Sun Micro. And I remember what it was like to be asked about all these, financial companies and the like, and, anything attached to real estate, going back to right before the financial crisis. But one last name on this guy before we move on. Well, actually, I just want to say this. I think Intel's dead. I think AMD is probably going to fill in that entire gap. It's actually in that gap right now, guys. So remember, they got a huge OpenAI contract. There is a through line here. and it's OpenAI. And we've been harping on this for a very long time. They put out, $1.5 trillion of contracts. Oracle got $300 billion. AMD got, $100 billion or something like that. AMD's stock rallied from 160 up to 260 in a month based on that. There was a huge gap, right? It's filling in that gap. It's gone from 260 to 200 in just a few weeks. And then Intel should be dead. I don't care that the government took a 10% stake or anything like that. But so to me, I think you got to keep an eye on mind the gaps, guy. Mind the gaps.
Which is a great title, which we've used. Carter talks about it. Elizabeth Thomas talks about it. And, the round trips have been fast. You just mentioned AMD. It was a $165 stock in the beginning of October. You just said it. Traded to not in a straight line, but effectively in a straight line to 267. And here below 200, I think it's somewhat of a foregone conclusion that we're going to do exactly the same thing that we did in Oracle and some of these other names. So I understand the want for enthusiasm and excitement and all those things. Math actually does apply at some point. And I think that's what the market has now learned over the last few days.
Yeah, and so Intel has a gap too. I just wanted to point that out. And the last thing on this, and we'll move on, if you think that there's going to be some sort of rejiggering of the OpenAI Oracle deal because Oracle now doesn't have the money or they can't go to the debt markets to raise the money, and I think that's one of the reasons why the stock has traded this way, right? The CDS is starting to move out a little bit, and people say, well, it's not that big of a deal what we're seeing so far. Something's going on because the equity is being sold aggressively. The last one, if there's anything that goes on with Oracle, CoreWeave's dead. It's dead. I mean, they don't make money. They actually, to fund their entire build out, they've had to raise debt here. And so to me, if you want to look at a gap, this thing went public at $40 in late March. And I think there's a really good chance that this is on the way back there. And, it became a meme stock. It became a good example of just kind of, how a pure play can work in this space. So again, I'm not a hater on this thing. To me, it just seems kind of obvious. And I'm looking at revenue growth of, over 100% expected over the next few years. Losses are going to continue or expected to continue over the next few years. But this is a company right now that $33 billion market cap, $2 billion in cash, and 18 or 19 billion in debt on the way higher. It's just that simple. So again, last one, Dell reports on Tuesday afternoon, guy. We know that Dell makes the servers that go into the data centers that train the models. We know that what goes into the Dells, there's racks, right? Obviously that keep them all together. There's cooling systems and the like here, but it's also the chips. It's also the memory, which is Micron. It's also the storage, right? There's other components in there. This stock has sold off 30% from nearly an all-time high in the last month. What do you think Dell's telling us? And Morgan Stanley,
it was 168, I think, in Halloween. It's 119 or something now, and that has been basically a straight line to the downside. So
Morgan Stanley's double downgrade.
Fine. It's going to be the guidance that's going to be a problem. And you would get a double downgrade. The earnings, the quarter's rearview mirror stuff, I think people understand that. It's going to be the guide. And I think unless they something that I don't expect, by the way, we said very similar with Nvidia, the stock is, I think, headed lower. And listen, for 24 hours, I felt like a dope. And I'm looking at this and I'm trying to figure out why Nvidia was trading the way it was. And now I think some reason is coming back to the market. I think people are now starting to go through the numbers and say, well, wait a second, maybe we shouldn't be looking at this through a certain lens. Maybe we should be looking at sort of a historical basis. And maybe the slowdown that we are seeing in terms of percentage guides actually is meaningful.
Yeah. Last thing on that double downgrade from Morgan Stanley, they were talking about Micron memory and pricing power there, okay, because of demand. And, when you think about this is a company who's seen its margins go down over the last few years, 24% gross margins just a couple years ago, expected to be 20.5 this year, maybe 20 next. So every bit of pricing power that a Micron has, obviously that weighs on Dell's margins, which are not particularly high in this environment. You also have Supermicro, which is basically competing with Dell, and they're undercutting on margins. And Micron has gone from just 260 guy last week or on Monday, and here it is right now at 197. So it feels like some of this stuff is starting to come undone. So Dell will be a really interesting data point. Thursday night, CNBC's Fast Money, Bill Simon, former head of Walmart North America, was on that night talking about the Walmart report. Everyone seemed pretty excited about it. The stock was up 6% in a day that the market had a huge reversal, wasn't trading particularly well. On Friday, it's down 1.25%. He talked about a consumer based on what he heard from Walmart is resilient, it's hanging in there, and this and that. You had one comment for him after the fact.
Well, I said, I respectfully disagree. I am not denying the spending numbers. I mean, the numbers are what they are. The consumer spends. My question all along has been, should they be spending? Because spending doesn't necessarily imply, it could mean a healthy consumer, but by definition, it doesn't mean a healthy consumer. And I think you're seeing the exact opposite. And I look at delinquency rates across a swath of different things: student loans, auto loans, mortgage rates, credit card rates, all are starting to inflect to the upside. For whatever reason, people don't think it's a big deal. Maybe I'm making too much of it, but we're at a point now, and I've said it a number of times, people have been fighting inflation with credit, and that's not a healthy brew. So he talks about the consumer through the lens of their ability to spend or their want to spend. I look at it and say, you know what? They're spending, but they shouldn't be. And I think that's all going to come home to roost. Now, you're not seeing any problem in the credit markets yet. You never really do. It's sort of one of those things that happens slowly, then all at once. And I don't know if we're on the precipice of that, but I certainly think we're a lot closer than we have been. So what has wound up happening, and this is something that we thought, places like Walmart win. Walmart, I think, recently made an all-time high of 109. Places like TJX win. Places that are nowhere but are in the middle, like Target, lose. Home Depot, which should be doing okay theoretically, is starting to show signs of weakness because of what I was talking about, the sort of the health of the consumer. And I think I think in 2026, I think one of the main stories is going to be the health of the U.S. consumer and delinquency rates. So that's coming to a theater near you.
Yeah, you are nothing if not respectful. We kind of teased the fact that, Fed President of New York, Williams, this morning, this is what got that CME Fed Watch tool turned around a bit. It went from 36% or something like that of the probability of a 25 basis point cut at the December 10th meeting. And now it's, I think, about 75%. He basically supposedly is a big ally of Jerome Powell, and he was endorsing another adjustment lower to get to a neutral rate. He said they're slightly restrictive. Home builders have gone crazy. And on the other side of that, guy, maybe it is one of the reasons why retail is acting so well, right? If you keep hearing that this consumer is resilient. But I just want to play a clip for you. This is an old friend of yours, an old colleague. His name is Harvey Schwartz. He is the CEO of the Carlyle Group, a monster private equity company. He was on our good friend Wilfred Frost's podcast. I think it dropped on Wednesday. So go check out the Master Investor podcast in your favorite podcast store. Follow it, rate it, review it, share it. That's how people find Wilf's podcast, by the way. But listen to what Harvey had to say, first of his business, okay, but then also the consumer, because on the back side of this, I'd like to get your take. You had plenty to say about what a lot of the money center banks said about the consumer over a month ago, and who knows what has changed. But let's listen to Harvey for a second here.
I would say that if you look across our portfolio, EBITDA, cash flow as a proxy, has been growing 8, 9, 10% across the board. Companies are doing very well. Inflation is definitively sticky. Employment growth at the margin has been slowing, but not degrading, notwithstanding some of the headlines of big layoffs in the United States. And so I would say overall, the economy feels quite resilient. Part of that is because consumers in the marketplace have more confidence, notwithstanding all the events that have occurred. And the greatest economic elixir is confidence. And if people have confidence, they will spend. If they feel good about the political framework, they'll feel confident about their jobs. You have to look through all that noise and ask yourself, is the economy pretty good or not? And the answer is pretty good. And if earnings hold up, the markets will hold up.
Look at that nice little song. We don't have songs like that come after our clips.
That's pretty cool.
That's
well,
pretty cool,
he's
Will.
British, Will, so he's allowed to play.
He's very British.
Is there a distinction between British and very British?
Yeah, there's a lot of Brits are not like Wilfred Frost.
Yeah, but all right. So let me ask you a
clear.
question.
Yeah.
Since you just brought it up, well, I brought it up, and then you sort of built upon it.
Yes.
He has great teeth, so how can he be very British?
Well, he doesn't have summer teeth. Some are there, some are here. You ever hear that
No,
one?
he does
That's
not.
pretty good.
He's got a beautiful smile.
Listen, we don't want to embarrass. He's a posh British man. I mean,
I love Wilf.
I do too. That's why we just played a clip. All right, Harvey. Used to work with Harvey back at Goldman Sachs.
Love Harvey.
So from where he's sitting, Guy, obviously he started out talking about the business. It seems like the business is doing just fine. I think that private credit, private equity, they're in the middle of a lot of stuff there. He talked about EBITDA and the way it's growing and all that sort of stuff. So they feel good about their business. But what he had to say about confidence, what he had to say about the labor market, what he had to say about a consumer, I mean, I think you and I both take a little issue with that. We're not telling you that, he's wrong and we're right. I mean, we're just trying to bring up the other side, I guess, of the trade.
What he said, and listen, Harvey is a lot smarter than I am, and he sits obviously at a much different perch, number one. Number two, my takeaway was, and this is something we have talked about for years, it's a confidence game. And when the U.S. consumer feels good about things, they will spend under just about any circumstances you can throw at them. When they start feeling a little dicey about things, that consumer spending stops on a dime. My assertion has been, and again, I'm not suggesting I'm right, but I think what scares the U.S. consumer more than anything, more than political ramblings and tariff talk and on those uncertainties, is what happens in the stock market. Because for whatever reason, whether people own stocks or don't own stocks, when they see precipitous drops and when the evening news leads with a stock market in decline in a measurable fashion, that gives people pause because they associate a stock market sell-off with the health of whatever. Typically it's economy, but other things as well. And you can go back in history over the last couple decades and you can draw a line between consumer spending and these dramatic sell-offs in the market. So to me, he's right in bringing up confidence. I'll just add to that, the confidence, in my opinion, is obviously having a job. I mean, that's first and foremost. But the other thing is how well the market's doing or not doing. Because when people see the stock market goes up every day, they assume that things must be fine. If things must be fine, they are okay to spend. If they see the stock market sell off in a meaningful way, they say, what's going on here? It's like that scene in Jaws. If you yell Barracuda, nobody looks up. You yell shark and you have a panic on the 4th of July.
Yeah. And just to take a page out of your playbook, if you were one of the 1.5 million almost, folks, federal government workers who were furloughed or made to work without pay for 40 days, right? If you were one of these 40 million folks who rely on SNAP food assistance, right, to put food on your table, if you were some of the workers that were fired, from the federal government, if you are some of the 13,000 Verizon employees that are about to get, notices. Amazon is doing 15. I mean, the list goes on and on, right? Think about what that does to consumer confidence. And so if you also think about this could all happen again on January 30th, because we just had that stopgap bill, right, that funded the government, I mean, consumers should be a bit cautious right here, because of the labor market, because of the fact that, you might get a rate cut, but the long and variable lags that you will have there, the housing market, it sounds like, 2 months in a row, we've seen a pickup. Fine. Mortgage rates have been bought down by home builders, for a while. So when you see these home builders rallying, it just seems like it's a stock market thing. And you're also seeing, like labor is an issue for home builders. The input costs because of tariffs are issues for home builders. So if you're going to get excited about the home building or the housing market getting unlocked, it's probably not a great time to do that. So again, I mean, you and I remain cautious because we're trying to pick the other side of this thing out, because you can have CEO after CEO where it's in their best interest. I'm not talking about Harvey. I'm talking about these more consumer oriented ones. It helps their narrative. It helps maybe if you are in the retail space, it helps their narrative. If you're a tech company that relies on consumers, it helps their narrative. But there's, the stock market's really good at calling out bullshit, right? I guess. So
at the end, I think when all said and done, again, you just pointed out the move of the home builders today, Friday, to the upside. That's a knee-jerk reaction to exactly what you just talked about, that Fed Watch tool going from 40% to 65%. And for whatever reason, the market associates, it's just sort of a Pavlovian response that if you're going to get rate cuts, it should be supportive of home builders. And listen, maybe it's just a bounce off an oversold condition in home builders, but to me, it's not. It's as much as people want to make it an interest rate story, it's more than that. It's the input cost story and it's a employment story. And both those things to me are going the wrong way.
All right, man. Heck of a week. here, and I think there was one of the days where you said we want to bookmark Thursday. What happened in the reversal there? What happened to the idea that we had a really good report and guide from Nvidia, and that investors initially bought it, and then they sold the crap out of it, and they didn't just sell it, they sold everything around it. You did see a rotation into some other groups. You're seeing that today on Friday, which is one of the reasons why you're seeing the indices, unched in the face of a lot of these names that continue to go lower. But we have a holiday shortened week. Guy, thoughts next week? What are you thankful for, brother?
Well, friendships, your friendship. I'm thankful for all the people at Risk Reversal, Amanda, Cece, Timmy, Bill, Jacob.
Yeah, we'll do this all again. We'll do this all again.
You just asked me. What
I know, but Bill is just laughing at it. He thinks we kind of jumped the gun on that one, by the way. I just want to be really clear.
People ask me questions. I answer the question.
Can we do it? We should do it again on Tuesday. So on Monday, you're going to be listening to this on Monday. And then on Tuesday, we have another RiskReversal podcast. Monday and Tuesday, we're going to do the market call, you and me, which will be a lot of fun.
Sure.
And then we're going to take Wednesday off, I think, Guy. How about that?
Oh, you got it. Even God rested on the seventh day.
That's right. And Friday is a half day. And sometimes it used to be a little goofy. You know what I mean? On these holiday shortened weeks, you have Thursday off, half day on Friday. Sometimes they say don't short a dull market. So maybe there's a bit of that. So, okay, we'll see them all back on next week early. Thanks, everyone, for being here.